Well, hey there. It's Terry Sawchuk. It's Thursday, so that means it's time for 3 Minute Thursdays. It's been a really interesting and kind of an important week in economic terms. We got the quarterly refunding announcement on Monday and again on Wednesday from Treasury. And the reason this is important is because they talk about how much debt they have to issue and then how they're going to finance it, meaning are they going to do short-term bonds, intermediate-term bonds, long-term bonds? And without getting too far into the weeds, it came out a little bit more hawkish than what people thought. And there was some speculation from a political standpoint that because both Janet Yellen and also Jerome Powell really don't want to see a regime change, they want to see Biden win another election, that they would certainly be more dovish and do what they can to kind of juice the markets. Well, that did not happen. I would say it was more of a good cop, bad cop. I think Janet Yellen played the bad cop and definitely had more hawkish things to say. And the way that she issued the debt, more long-term debt than what people thought was going to happen, which, you know, when that happens, when they issue more long-term debt, it increases supply, okay, into an already area where there's not a lot of demand. And so it pushes yields up. It pushes interest rates a bit higher. And then kind of the opposite on Wednesday, the Fed didn't really do anything with interest rates, which was not a surprise at all. But a lot of people thought Powell would be a little bit more hawkish because inflation's been running kind of hot. And instead, he talked about how supply chains are loosening up. And not only that, but productivity is high. And some of the wage gains might be slowing down. And so that was perceived as more dovish. Now, Thursday morning, we got data that flew in the face of that completely. The productivity data started to slow down a little bit, which was a little bit surprising. And inflation, again, still kind of running a little hotter than what they have said in the past that they want, which was 2%. So I think what you're seeing is a period of what they call quote unquote fiscal dominance, where because our debt is so big, the government is just going to continue to spend more money than they should, and they're going to have to keep interest rates reasonably low. So I don't think they're going to let rates get much higher than they are right now, at least not on the short end. But the long end, you know, the long-term rates could creep up a little bit. In the end, okay, this was not great for the stock market. Not bad, just not great. So I expect more volatility, probably a downward direction, but maybe not a big crash, just, you know, an orderly sort of decline where we take some valuations off. We've made some adjustments to our portfolios to accommodate for this. We're in a good position. We don't have a lot of risk, but we've still got the potential to do reasonably well over the next couple of months. And we'll look for better valuations where we can buy in and hopefully capture some alpha on the other side. So that's going to run this week's edition of 3 Minute Thursday. I will see you next week. Take care.